Planning for retirement may not be fun, but it is essential in order to ensure a comfortable and enjoyable retirement. I'm going to go over techniques on how to maximize your retirement investments for growth, sustainability, and tax savings. Before we begin, if you like this video, please hit the like button and subscribe to the channel. As always, if you have any feedback, questions, or suggestions, please comment below. Maximizing your retirement investments does take some time and effort to set up. However, after that, it is mostly on autopilot. The first step is to take advantage of any employer-offered 401k plan, specifically making sure that you contribute up to the maximum matching contribution that your employer makes. If you are lucky enough to have an employer who offers a match, say 4 or 6%, take full advantage of that. It is literally free money that will also accumulate and grow over time. The earlier in your career you can start contributing to a 401k, the better. It will give your investments more time to compound. Also, establishing your contributions early is much easier psychologically because the money is automatically deducted from your paycheck. You never learn to depend on it. A final consideration with your 401k is whether or not to contribute after-tax dollars to a Roth version. Roth 401k are newer, but now becoming more prevalent. For most people, unless you are nearing retirement age, using Roth contributions will be the best bet. You should certainly talk to your HR department or company representative for more details. After you are contributing up to your 401k match, the next step is to max out your contributions to a health savings account, or HSA. This may be the best kept secret for retirement, and not a lot of people are taking advantage of it. Before going into the details, note that starting an HSA requires you to be enrolled in an eligible high-deductible health insurance plan. If you are not, then you will need to skip this step. Again, consult with your HR department for more details if needed. If you are eligible, starting an HSA is relatively easy. Check with your existing bank and financial institutions to see if they offer one. Some popular options include Fidelity and Bank of America, but many other good options are available. So why do I recommend maxing out your HSA as a second step? The reason is that HSAs have enormous tax benefits. In fact, they have 3 tax advantages. First, contributions to HSAs are deductible off of your taxes. Second, you can invest your HSA dollars, which will grow tax-deferred over time, just like your 401k. Third, you can withdraw money tax-free so long as it is used to cover qualified medical expenses. For retirement purposes, you will not want to spend the money in your HSA, and instead invest it. This seems counterintuitive, but if you can afford to pay your medical expenses out of pocket, your best bet is to not touch the money in your HSA until you are at least 65 years old. The reason for this is that the money in your HSA can be invested, just like your 401k, and will grow over time. The more money you keep invested, the more it can grow. From now until you are 65, keep meticulous records and receipts for all of your qualified medical expenses paid out of pocket after your HSA is established. Why? This is the best part. Once you turn 65, you can withdraw the total amount of qualified medical expenses accumulated to that point as a reimbursement, completely tax-free. This is truly an amazing tax advantage. You will be able to continue to withdraw and pay for medical expenses beyond that amount into retirement. After 65, you can withdraw and use the money for other, non-qualified purchases, but you will need to pay income taxes on that similar to other non-Roth accounts. Also important, if you take any money out of an HSA for non-qualified expenses prior to turning 65, you will have to pay a 20% penalty. Avoid this at all costs. In summary, maximize your HSA contributions, invest as much as you can, save your medical receipts, and do not spend the HSA money until you are 65 or older. The next retirement account you will want to set up and contribute to is an individual retirement account, or IRA. You are likely familiar or have heard of an IRA. They work similar to a 401k, but they are individually established and managed, versus through an employer. Typically, IRAs will provide more flexible investment options. Similar to a 401k, you should consider whether you want to contribute to a Roth or traditional IRA. Technically, you contribute to both, but regardless, the same income limit applies across all of your IRA accounts. Beyond the annual contribution limits, one gotcha with IRAs is that there are income and other limits that may apply. These limits also change over time, so do some research. Firms like Fidelity offer great customer service and can help with your specific situation. The last step in maximizing your retirement investments is to go back to your 401k and contribute up to the maximum amount. In 2022, this is $20,500 or $27,000 if you are age 50 or older. One approach to increase your 401k contributions over time is to do it in conjunction with any pay raises you receive. This may be easier than reducing your current paycheck amount. A final point across all of your accounts is to look at them holistically and optimize your investments across all of them together. Consider them a single retirement portfolio. You especially want to manage risk to fit your needs and age. Also, make sure to avoid over-diversification within each individual account. For most people, I recommend choosing 1 to 3 funds within each account that match your goals, are easy to understand, and that are reputable. I hope you enjoyed this video and can apply these ideas to your own financial plan so that you can achieve your retirement goals. Thank you for watching and have a great day.